Good morning, everybody, and thank you for joining me today to talk about taking control of your fleet's future with captive insurance. As I go through, you're going to see a Q&A box, and feel free to put your questions there. I'll try to answer them when we're on that slide, but I may come back if I think I'm going to cover that information later. But this is really a unique topic. It is something that there's a lot of confusion on, there's a lot of mystery about, and it really does not need to be mysterious. National Truck League has been around since 1989, and we've got a staff of 45. All we do is trucking. We're trucking insurance experts. So I thank you for joining us today. Our head office is in London, 401 near the Flying J. And that bottom left picture, I'm happy to say that Mayor Hazel opened our Mississauga office, which is near Pearson Airport. So we have a lot of experience and a lot of people with a lot of experience ready to help you. Let's talk about what is captive insurance. You may have heard of it as self-insurance, like you're self-insuring and getting rid of the insurance company. That's a good way to think of it because you are going to self-insure part of your claims risks. With Polaris, which is the captive I'm talking about today, your trucking company could be a shareholder of an offshore insurance company. They're typically offshore because they can earn investment income tax-free until it's repatriated into Canada. So there are some benefits that way from a cash flow and from an investment point of view. But they are still highly regulated by Canadian regulators. There is a Canadian insurance company that is involved in the captive. There always has to be with offshore insurance. And in this case, it's Old Republic. And Old Republic is regulated by the Canadian insurance regulators. But essentially, it's top trucking fleets like yours that are committed to trucking and safety for the long term who have created a new insurance market. There are only a few insurance markets in Ontario right now that are interested in insuring your type of business. And they come and they go, they're with us, they leave us. But this is creating an insurance market that you have complete control of. It's an opportunity for you to get ahead of your insurance renewal. So let's just talk about some of the benefits of insuring your company with the captive market. Number one, and I think this is important, there's more predictable renewal rates. There will be no surprises when you renew the next year. You do not have to worry about an insurance company deciding to change the rules. You do not have to worry about they insured carrier XYZ who just had a horrendous year and is blowing them up and they've got to pass price increases on to everybody. You don't have to worry about that. You are in control of your renewal. It's an opportunity for you to partner with the top carriers in Ontario, and you will learn new best practices for safety. There's a safety meeting every year. It's likely virtual this year due to COVID, but you learn and you share because every one of those other carriers is a shareholder in the captive insurance like you. They want you to have a successful year, to have as few claims as possible, and then that will actually bring some profit to them. There's a great potential for profit sharing with captive insurance. I'm going to let you in on a secret. Insurance companies have a target loss ratio of 65%. If they write $1 million in premium, they want to pay out no more than $650,000 in claims. I can tell by the group that have registered today, you have seen years, if you had $1 million in premium, where they only paid out $150,000 or $200,000 in claims, and they make the profit. With a captive insurance, you have the potential to make a profit and get dividend income in the future. And all the while, your underwriting profits are accumulating and earning interest and investment income, tax-free and offshore, tax-free until you repatriate it. So this is a big thing. Is there's enough to worry about with trucking. You have to worry about, was Donald Trump going to introduce a new tariff next week? You have to worry about fuel prices. You have to worry about your clients may be going out of business, being impacted by COVID. But this is something that maybe you're worrying about. Maybe this is a thing that wakes you up at 2 a.m, wondering what is your renewal to come in at. You can own it. You can own your renewal. So there are a number of layers involved, and these are risk layers. And I'm going to take about 5 minutes to go through this because it can be a little confusing at first. We're going to look at the blue right column, and at the bottom there's a deductible. The deductible is, if you're coming new to the captive, it's going to be $25,000 maximum per occurrence deductible. That may be more than what you have today, but you are going to be responsible for a deductible just like you are today. Then there's a dividend pool. This is where your profits come from. This is where you are funding the risk from $25,000 to $225,000. So that means if you had an at-fault claim and it was $40,000, you would pay $25,000 deductible, and $15,000 would be funded from your dividend pool. There's a risk-sharing pool, and this is really interesting. This is where all of the captive shareholders share in the risk from $200,000 to $500,000. There are the odd claims that pierce that $200,000 mark, and everybody shares in this. It has been quite profitable the last few years, and when there is profit in this pool, it is then transferred to the dividend pool. So that means at some point you will be dividended out with the profit from the risk-sharing pool. And then from $500,000 to $2 million, Old Republic is the insurance company. They pay for all of the claims there. Old Republic is a great insurance company in Canada. All they do is trucking, and they're a sister company to Great West Casualty Corporation, which is the largest truck insurance company, specialty company in the United States. So they know trucking North America wide between those two entities. Let's look at what your captive annual cost breakdown might look like. On the left column, you have lines of business. This is the type of risk. This is an insurance term, but the risk and the premium that would be associated with it would be cargo, of course, your general liability, which means you damage somebody else's property, auto physical damage, so something happens to your tractor or trailer, and then auto liability. There's the dividend pool. We've just talked about that on the last slide. So that is the second from the bottom right box there, the dividend pool. There is the risk pool. That's what you would share with the shareholders of the captive. Combine those two for a total loss pool. And then there's expense and reinsurance. So Old Republic would be a part of that for your final premium. The dividend pool is where all the action happens, really. There is a premium assessed for the risk pool, and it's just based on losses and premium collected. But the dividend pool is where the action is. When you first get into a captive, you're going to build your dividend pool to be 2 times what the estimated dividend pool claims will be. There are also other expenses that are called claims admin fee, offshore expenses, and ARU administration. ARU is based in Chicago, and they run 30 captive insurance programs. So they're highly experienced and great to work with. So here's an example. Current premium about $530,000, and you can expect an increase at renewal. You'll be, let's say, in the range of 7 to 12% this year. Number one, you're going to have a higher deductible, so that will decrease the premium. Number two, we can see in this example, the dividend pool is coming in at $170,000. That would be based on what your claims experience has been. And over the course of 3 or 4 years, you will build your dividend pool to be double of what the expected claims will be. It's like prepaying your premium. So in this case, it will be 40% of that $170,000, so $68,000 extra for the first 3 or 4 years until that dividend pool was up to $340,000. Once it's above that 2 times amount, then that amount, let's say you needed double was $340,000, and if you had $400,000 in that, then the $60,000 would be eligible to be paid for dividends. So let's talk about a little bit more about this dividend pool for a second. So in this example, carrier is going to build the dividend pool to $340,000. I have a client that is in this pool. He had a claim that was virtually 2 times his dividend pool. He did not get it. He got a 5% premium increase that year. And then he would have paid $170,000 at renewal. And then he would just start building it again at $68,000 per year. He would build that collateral. So isn't that much better than having a loss like that and wondering, how is your insurance company going to react to that? What are they going to do with rates? How are they going to treat you? It's just a much better situation. So this example is how it would work. There are some qualifications to get started in the captive insurance. Have to have a satisfactory rating or higher, and you wouldn't want to be a shareholder in this and have somebody with unsatisfactory CVR rating. All insurance companies do not want to see a rapid growth. So if you're a carrier that had 20 units 3 years ago, and now you're at 60, you may need to delay your entry because they want to make sure you can manage a 60-unit fleet. There will be a financial review at the time of binding, not at the time of quoting. They want to ensure that drivers and owner-operators are protected, and that protects the captive from accident benefits claims. And they're certainly all over this. There are some ELDs that are editable. That won't be around for too much longer, but they're certainly well aware of the manufacturers that make those editable ELD systems. And finally, you need a minimum of $300,000 premium that you're paying today. If it was less than that, just the numbers don't work. So if your premium to get up to $2 million liability is $300,000 or more, and you meet all of these things, you are a candidate to start in the captive insurance. So what else is needed to get started? Well, there is cash flow. So a few things here. I know some carriers have been impacted. All carriers have been impacted definitely by COVID-19. So is your cash flow right for today? There's the share purchase. It is $30,000 for one share. You can only buy one share. You can sell it if and when you get out and get your $30,000. And any investment income earned by that share is applied to your dividend pool. They do require collateral for deductible. So in the case we're talking about, the example, $25,000 deductible. So required to have $75,000 letter of credit so that 3 claims will be paid. There's no question that the deductible will be collected. And finally, the dividend pool collateral funded over 4 years. And so in the case that we talked about, that was $68,000. Again, consider it a prepaid. Your accounting people would consider that an asset. It's just moving from cash to another asset, a prepaid premium. So it's not going to impact your balance sheet, but it will be required. And that can be done. There's got to be at least the first 40% has to be cash. The rest can be letter of credit. And the next step, the process is with some data from you, we can give you a premium estimate. We're not the underwriters, but we'll be very close. We can do a projection of the dividend pool, how quickly it will be funded, and when you will start to have a surplus in that dividend pool and start talking and thinking about getting dividend checks from the Cayman Islands. So there's a lot of things we can do before there's a big submission. We definitely need some information though. And then we would create a detailed plan for you. Either we can do a couple of things. We can create key indicators like you would for your operation. It'd be for your road to insurance independence. Here's what the indicators are. Let's watch them. Let's create together action plans to make sure you meet the goals and are acceptable to the captive. And if your fleet isn't qualified or not ready yet for any type of reason, you can get on the NTL road to insurance independence, and we'll plan how to get there. We can work with you, and one of the scorecards we could work on is surplus cash to build up for the share and for the dividend pool. The documents are, it's information you have already. Loss run report, 5 years in Excel, if at all possible. Truck count year, owner operator year, count per year, your most recent CVR level 2, and a full SMS report. Once we get that, there would probably be Q&A on the loss runs. Where did it happen, for example? Not all loss runs have that, but that's a pretty quick and easy thing to do. We do that with your safety people. So to conclude, there's a few things that are required to get into a captive. And I'm a business owner like you are. Question I would have is, am I ready to take on more risk? Running a trucking company is risky. It has risks involved. If you've been in a business a long time, you're very comfortable with those risks. Are you willing to take on more risk? Are you willing to bet on your fleet? Are you ready to bet on your safety practices, your safety and compliance team, and what they can do for you? It requires good historical results. So if you don't have a good recent history, then get on the road to insurance independence and build a history. It can all start now. If it's going to take you 3 years to get into a captive and you really think, yeah, that makes sense, I love it, I want to do it, we can start on that road today to be ready from 3 years, and where the history is a little further behind. And it requires an investment, but it really is not as much as you might think. So the next step is, I'm going to see if there's any questions and answers, or I'll see if there's any questions. I'll give the answers, I hope. And I'll send up an email to schedule a time to see if you're interested to chat further. So I have a question. How long would I have to be in the captive to start seeing dividend returns? So that's a good question. It will take you 3 or 4 years to build your dividend pool. And then it will take another 1 or 2 years to get to that comfort level. So you're probably looking at year 5 or year 6 before you can start seeing dividends if you have good years. It is theoretically possible to have that dividend pool funded, fully funded after 3 years. It can happen. And then it would be quicker, but you're looking at about 5 years before you would see any dividend return. There's another question. The $25,000 deductible is a lot higher than I have right now. Is there any way around that? Okay, so that's a good question. If you're looking at a captive, you want to be comfortable with risk. You want to be comfortable that you've got good, well-maintained equipment, that your people are hiring the right drivers, that you want to look at your lanes and you want to be comfortable with the $25,000 deductible. If you hire owner operators, they will not be comfortable with the $25,000 deductible. We do have a deductible buy down program to help captives in that situation. I hope that answers it. Our clients in the captive typically paying a higher insurance premium than they would in the standard market for the first 3 to 4 years, since they are paying premium plus funding the dividend pool. They're typically paying less premium. The renewal increases are way less than the regular market. It will be less premium because of a higher deductible, but you are prepaying premium. You're funding that dividend pool, so the cash flow is a little higher than you would get in a normal market, but your premium expense should be less. Will they take smaller companies if they fit all criteria except gross premium or fleet size? I can ask that. They are saying 3 million, that the numbers may not make sense, but I think we should talk live and see how close, not 3 million, 300,000. Did I say 3 million gross premium? 300,000 gross premium. We can talk. If you're close to that, they will be interested. Does the captive write hazmat? Yes, they do. They've got some good hazmat carriers there. Let's give another minute for other questions, if there's any. Well, I'd like to thank you for your engagement. I'd like to thank you for joining today to learn more about options that you would have in the future. I will send a follow-up email if you're interested to talk more, to share your information so we can get an estimate from you and an estimate for you and a projection of premium and what your dividend pool will look like. That would be awesome. We'd love to be of service. Thank you for joining today, and I look forward to talking to some of you in the future. Thanks. Bye.